Hi, everyone. We are going to begin covering Chapter 3. This is income tax, and this is fall of 2025. So we're going to start right away. I just want to make sure that I am sharing my screen so that way you have it. Great. This is Chapter 3. Here we're going to take time to talk about Schedule C primarily and business income and expenses. So you see here, we're going to look at the profit and loss statement, which is known as a Schedule C. We're going to talk about inventories. Inventories are a current asset, and then when they are sold, they become cost of goods sold. We'll talk about transportation expenses, travel expenses, deducting meals, and business education expenses. Then we'll talk about dues and subscriptions, uniform and clothing, business gifts, bad debts deduction, home office, when we can deduct that, and then looking at what constitutes a for-profit business and what's a hobby. So again, most of this is related to Schedule C. Know that in the big reform back in 18, they did away with employee expenses primarily for employees. Here we're talking about when you're a sole proprietor or a small business and what you can deduct on your Schedule C. So, a trade or business is any activity that's engaged in for profit. Now, that's a key. You can't just say, oh, I want write-offs, so therefore I'm going to start doing this. The intent of the business has to be that your plan is to make profit. It doesn't necessarily mean you're going to make profit this year or next year, but that is ultimately the whole purpose of you starting that trade or business. For expenses to be generally deductible, they need to be ordinary and necessary for your line of work. They need to have a legitimate business purpose, and they have to be reasonable in light of fees that are generated as a result of the expense. So you are trying to connect with a client, and the revenues that this client is going to bring in is $1,000, and yet you spend $3,000 on travel expense for this client. Well, that is not going to be reasonable at all in light of the income you're producing as a result of this particular client. The code restricts the deduction of certain expenses. You cannot write off personal living and family expenses. You can't write off capital expenditures, and we'll talk about that because that sounds a little gray. You can't write off expenses related to tax exempt income. If you're not having to claim it as income, then you're not going to be able to take the expenses. You're not allowed to write off expenditures related to the sale of illegal drugs, illegal bribes, or kickbacks. So if you are engaged in an illegal activity, even though you're going to have to claim that as income, you're not allowed to write the expenses regarding these illegal activities. You're not allowed to write off fines, penalties, and other payments to governments related to violating law. You can't write off lobbying and political expenditures or settlement or attorney fees related to sexual abuse or harassment if you are the subject to a non-disclosure agreement. So, a Schedule C is used for those individuals who operate a business as a sole proprietorship. This is not a partnership. This is not a corporation. This is a sole proprietorship. Know that single member limited liability companies are able to use a Schedule C to write off their expenses because they are a sole member of the LLC. So the Schedule C has 5 parts: a portion where you show your income, a portion where you show your expenses, and then a portion on the second page where you show your cost of goods, the vehicle information, and then any other miscellaneous expenses will also go on that second page. Know when you are a sole proprietor, you're not an employee where an employer provides you with the W-2 and they take Social Security out and they also have to match that Social Security. When you are a sole proprietor, you are required to pay your own self-employment tax. So anybody whose net earnings on a Schedule C are $400 or more must pay self-employment tax on that income. That form is an SE, Schedule SE, where you pay the self-employment tax. Self-employment tax is made up of the Social Security tax and the Medicare tax. The Social Security tax is normally for an employee 6.2%, but since you are self-employed, you have to pay double the portion for the employer and the employee, or 12.4% of the first $168,600. The Medicare portion of 2.9%, if you were an employee, it would be 1.45%. You have to pay both sides, and that Medicare tax continues indefinitely. Now, no, a taxpayer who does pay social self-employment tax does get to take 1/2 of that self-employment tax and write it off as a deduction for adjusted gross income. So they do allow you a benefit since you are having to pay both sides of that tax. They do allow you to treat that as an adjustment to arrive at adjusted gross income. Okay, here, Terrell owns a small business and takes a client who's a friend to an expensive dinner every week. They enjoy a variety of restaurants and wines, and usually these meals run about $20,000 for the year. Terrell gets $15,000 of fees from the friend each year. Is this yearly cost deductible? If not, what could Terrell do to make with his friend that would be deductible? Well, guys, it's just clearly not. It's not ordinary and necessary, and it's not, definitely not reasonable. As you see in this debrief, it's lavish and extravagant, so it wouldn't be considered reasonable. If they'd met for pizza, then possibly that would be reasonable, and as a result, it would be deductible. Now, inventories are when a sole proprietor either manufactures inventory and sells it or purchases it for resale. Inventory is the stock of goods a business holds to sell and make a profit. Cost of goods sold is the largest expense for manufacturers and retailers and also wholesalers. So this accounting for inventory really needs to be done carefully. You need to make sure you know how much inventory or items are being added to inventory throughout the year. You need to know what you began the inventory with, and you do need to take an actual count of what your ending inventory is throughout the year. Small businesses with gross receipts under 30 million can use the cash method. They can treat it as a non-incidental material and supply, treat it the same as on the applicable financial statements, or treat it as it conforms with the business books and records. Most businesses have to determine the value of beginning and inventories. They need that in order to determine the cost of goods sold, along with all the inventory that was purchased throughout the year. Know that there are two methods. Most companies do use the FIFO method to account for inventory. The first in, first out. The LIFO method, the last in and first out, is another common method, but most businesses do handle inventory using FIFO. If the LIFO election is made, it must also be used. If it's made for taxable income reporting, it has to also be used for financial reporting. So guys, what do you think of this? Priya made the following purchases of a particular inventory item during the year. On March 1st, Priya purchased 50 units, August 1st, 40 units, and then December, 125 units. Her ending inventory is 60 units. Should Priya use FIFO or LIFO method of inventory flow? The benefit with FIFO is it's easy. It's the way natural goods flow. LIFO, in the period of rising prices, is going to allow you to have a higher cost of goods sold and ultimately a lower net income for income tax purposes. So it's really a matter of what the taxpayer chooses to do. Here we're looking at transportation expenses. These can be deductible on a Schedule C. They can include traveling, airplane, rail, or bus, and operating and maintaining an automobile. Transportation expenses may be deducted even if the taxpayer is not away from the taxpayer's tax home. And so we'll talk about that. No, commuting to and from work will not be deductible. Now, if the travel between the taxpayer's home and work locations outside the metro area where the taxpayer lives and normally works, possibly there could be a deduction here. Or the travel between a taxpayer's home and temporary work locations, if the taxpayer has a regular place of business, may be deductible. And then travel between the taxpayer's home and other regular or temporary locations, if the taxpayer's home is the principal place of business. So know this, that commuting, going to and from a general office that you usually go to is considered commuting. That would not be deductible. However, if the taxpayer does work at home and then is required to go to other locations, that would be a business travel expense. Or if there are temporary locations, that also could be a travel expense. It's easiest when taxpayers use what's called the standard deduction. So they just take the number of miles and they take that by 67 cents a mile. That standard deduction takes into account gas and oil, insurance, repairs and maintenance on the vehicle, and depreciation. So if you're taking the standard mileage rate, you cannot also write off gas or insurance or depreciate the car or show repairs and maintenance. You can, however, take the interest expense on the car and the car license fees. But if you're taking the standard deduction, what is associated with the standard mileage rate includes these 4 items here. Parking and tolls, interest and personal property taxes are allowed to be taken in addition to that standard deduction. In order to take that standard mileage, you have to either own or lease the automobile. It can't be a fleet of automobiles. And when you're using that standard, you're using the straight line depreciation. You're not using some accelerated method. And you can only use the standard if you haven't claimed Section 179 depreciation on that automobile. You can see method is better. You can begin by starting with the actual expenses of transportation. Taxpayers can change from the standard mileage rate to the actual cost during any year. If you're using actual cost, you really need to keep really good records. You need to know all of your gas, your insurance, your repairs, your car washes, your interest, the cost of the vehicle, so we can calculate the depreciation. And then you need to keep really good records to show your business miles versus your personal miles. No, when you are a sole proprietorship and you are using either the standard or the actual expenses, in order to create that transportation expense for a vehicle, we'll use the form 2106 to show those expenses. And then that form 2106 gets carried back to that sole proprietorship form. If you're using transportation expenses for rental property, which is a Schedule E, which we'll talk about in the future, you'll still use that 2106 that will flow back to that Schedule E. Or if you're using an F for farm work, just know that 2106 is used to report the transportation expense. And then that number flows back to the Schedule C. So which of the following costs is built into the standard mileage rate? We know that is depreciation. The other three you are allowed to take in addition. Now, to be deductible, travel expenses must result from a documented business reason. Meals can be included, but it's only 50%. Lodging is another form of travel expense, taxis, tips, and laundry. They can be deducted as long as you can substantiate them, that you have documentation for them, that they're ordinary and necessary and reasonable. Lavish or extravagant are not going to fly with the IRS. In order to write off travel expenses, you need to be away from your home overnight. Not that it means 24 hours, but it's longer than an 8-hour workday. Know that a tax home means your principal place of business. It's not always the same as the location of where the family lives, but it's where you go to work. If you have a temporary assignment for work, you're allowed to write off those expenses if it's not realistic for you to return at home at the end of the day. So let's say you have a temporary place 4 hours away from home. Well, you're not going to travel 8 hours each day to get back home and go back there. So that would be reasonable that that temporary assignment would require some transportation expenses. Assignments that last more than a year, generally speaking, are going to require that becomes your new tax home. So no, if you have a temporary assignment that's going to last over a year, generally speaking, you're not going to be able to deduct those travel expenses because the IRS is going to look at that as that's becoming your new tax home. That is where you are working. Business trips within the United States are primarily deductible. If a business trip is outside of the United States, then there's some more scrutiny. You need to make sure that you couldn't have taken a trip within the United States for that same purpose. And you need to make sure you split the portion that is personal and the portion that is business. Trips that are pleasure trips are not going to be deductible. Usually speaking, if a trip is at least 75% business, then you're going to be able to write that whole trip off. But treasure, pleasure trips are generally not going to be deductible for tax purposes. So here we're showing that Gabrielle travels to from Idaho to Mexico, New Mexico for a business trip. She pays $380 for airfare. She has lodging of $330. She has meals of $150. And while she's in New Mexico, she does a personal sightseeing tour, and she spends $400 on car rental and lodging and $85 on meals. What can she deduct for business travel? Since the trip was primarily for business, she can take the whole airfare. She can take the lodging. She can take 50% of her meals, since that's all that is allowed. But any of the personal expenses for this trip, the sightseeing tour, she's not going to be able to take. You cannot write off travel expenses unless you have records to document and substantiate the amount of each expenditure, the departure and return dates, and how many numbers of business days were on the trip, the name of the city or town that you traveled to, and the reason for the business travel. Per diem is another alternative to keeping specific records. Employers can use per diem for travel expenses, such as lodging, meals, and incidentals. So per diem is broken down by travel, hotels, meals, and incidentals, or they can use them for just meals and incidentals. So there are guidelines that are published for the per diem rates every year. Per diem, you're allowed to use that to help substantiate travel expenses. Know that employers can use them for the lodging, meals, and incidentals. But for self-employed individuals that are taking a trip on their own, not for their employees, you're going to need those hotel receipts. However, if you're a sole proprietor and you have employees, then you can use the per diem expenses for those employees. The standard federal rate method is where an employee is allowed a per diem amount equal to the federal per diem rate, which is shown on a guideline. Actually, let me see if I can find it right here. And every year they publish the per diem rates. So you can look up an area. I'm just going to go and look up Minnesota, and I'm going to look up the city of Minneapolis. And I'm going to show this is for 2025. And you can look and see what are the standard rates. Oh, isn't it showing it for me? Oh, let me see. You should be able to do that. There we go. So see here, for 2025, the lodging rates here that employers can use is roughly 148 for lodging. Meals and incidentals are $92 a day for meals and incidentals. So The lodging 148 plus the 92 is what you could take for your employees traveling. There's also some locations that have these high cost localities, and then other locations are low cost areas. Um, if you choose to use the high low method, you've got to stick with it throughout the year. Meals and entertainment. Entertainment costs related to recreation, social, or similar activities for the benefit of employees are deductible. A meal related to an entertainment event is deductible only if the meal is purchased separately. Dues paid to professional organizations or to civic and public organizations are allowed as legitimate business deductions. And celebratory meals, such as holiday parties and company picnics, you can write off 100% of that meal. Generally, meals are only at 50%, but those are allowed at 100%. Educational expenses can be a little confusing. Know this: if it maintains and improves your skills in your current profession or line of work, they're deductible. If it qualifies you for a new profession, it is not going to be deductible. Tax law for educational expenses is really, in this case, dealing with self-employed individuals. Qualified tuition programs, educational savings accounts, education tax credits, those are all taken care of in other chapters. But this says the educational expenses have to be paid to meet the requirements of the taxpayer's employer or the requirements of law or regulation for keeping the taxpayer's salary, status, or job. So, as a CPA, I'm required to have 40 hours of continuing ed a year in order to keep my license. Hence, because it is a requirement for me to keep my license, I'm allowed to deduct that. If I'm not a CPA, but I want to become a CPA, and I take a course to gain that CPA, that would not be deductible because even though I'm an accountant, it's qualifying me for a new position, a new trader position, which would be a certified public accountant. Taxpayers required to meet educational standards beyond minimum requirements may deduct the expenses of the education, since it would be required by either the employer or law, and travel expenses incurred while away that are due to obtaining that education are also deductible. Roxanne is a paralegal. She attends law school at night at the University of Texas, El Paso. Are her educational expenses deductible? Assume that 30 hours per year of continuing ed are required for paralegals to maintain certification in Texas. Well, her going to law school would not be deductible because that would qualify Roxanne, instead of being a paralegal, to become an attorney. So expenses going to a conference would be deductible. Meals would only be 50% deductible because her going to a conference is maintaining her skills in her current line of work. Professionals engaged in practice or employed may deduct the cost of dues, subscriptions, and publications to their respective periodicals. Dues to professional associations are costs of subscriptions to journals would be deductible. So which of the following would be deductible? Definitely not dues to a health spa. A subscription to a tax journal would be. A registered nurse subscribing to Motor Trend would not be. Union dues paid by a carpenter would be. And a self-employed physician paying dues to the AMA, the American Medical Association, would also be able to be deductible. For uniforms to be deductible, they've got to be not normal attire. They've got to be special clothing that are required as a condition of employment and that aren't suitable for everyday use. So when an individual is a UPS driver, well, that's an employee. So sometimes they're contracted out though. When they are required to wear specific logo type items, those, the cost of them, the cleaning of them are all deductible. Business gifts are pretty tight. You're allowed to write off only up to $25. And then in addition, you can write off the gift wrapping and shipping per year, per person. So it's not much. Here, where there's the biggest issue is oftentimes I have realtors that will give their clients a $500 gift certificate. Technically, they're only allowed to write off up to $25. Okay, guys, sorry about that. Let me go back. In terms of just want to make sure that the video is doing what I want it to. Hmm. Let me start that share again so I know I've got the right share up. Okay, there we go. So now in terms of gifts, I apologize for stopping there. I had a person I had to let in. Um, know that it's stringent. $25 per person per gift. You can add the gift wrapping and the shipping. But here's something, small gifts, you can have small gifts on items, but a deduction for gifts of tangible personal property made to employees for either the length of service on a job or a safety achievement can be deducted up to $400 per employee a year. So just know that that is allowed. And gifts made in conjunction with what we call a qualified plan is limited to $1,600 a year. Gifts paid to a taxpayer's supervisor are not going to be deductible. So, no, um, sole proprietors can make charitable contributions to qualifying organizations. Business charitable contributions are not reported as a business expense. They're going to be reported on Schedule A as an itemized deduction. To be able to report business gifts, you're going to need to be able to document the amount of the expense, the date, the description, the purpose of the gift, and real important, the relationship you have to that person. So Mark's a salesperson who gives gifts to his clients. Mark gives Mr. Alford a $20 gift, and Mrs. Alford, who's not a client, a gift costing $15. He also gives Miss Bland a gift of $24 plus $2 for wrapping. How much can he deduct? He can deduct the gifts for Mr. and Mrs. Alford up to 25 bucks only. And then for Mrs. Bland, the $24, you can write off the $24 plus he can take the $2 gift wrapping charge. Again, $25 is the max per taxpayer. If they're married, then it would be for total. When we're dealing with bad debts, they happen when taxpayers sell goods or services on credit and the accounts receivable later becomes uncollectible. Here's the catch, though. You have to have already included it in income for you to then go and write off that bad debt. Just because someone doesn't pay you doesn't mean you can write off what they didn't pay you. The only reason you write off that bad debt is because it was included in income, you didn't receive it, so therefore you can subtract it out. Taxpayers must use the specific charge-off method because the IRS is going to require proof that the debt is worthless. Debts arising from the taxpayer's trade or business are classified as business bad debts. Those are ordinary deductions. Non-business bad debts are treated as a capital loss, and they can only be written off a max of $3,000 loss per year in total. Now, if you have short-term capital gains of 20 and you have a non-business bad debt of 30, since you have the 20 in capital gain income and you have this non-business bad debt of 30, you would be able to write off 23,000 of that non-business bad debt because you already had 20 in capital gains, short-term capital gains, and then you can only max the net loss up to 3,000 loss. So that would be 23,000 of that non-business bad debt you could write off this year, and that 7,000 gets carried forward to future years until you can write the whole thing off. But the max again is 3,000 per year. So if Kiko loans a friend 20,000 to start a business and Lucas doesn't repay Kiko, is this a business or non-business bad debt? Well, it's a non-business bad debt because Kiko's lending a friend money. Okay? So that 20,000 bad debt, he can write it off, but if he doesn't have short-term capital gains to offset that 20,000, he can only write off 3,000 of it a year until he gets it satisfied. Okay. Office in the home. Deductions for business use of an office is allowed if the self-employed taxpayer uses that office as his primary place of residence of business. It's used exclusively and on a regular basis. Um, Used exclusively on a regular basis by patients, clients, or customers in meetings or dealings in the normal course of business. Now, a separate structure not attached to the dwelling unit and used exclusively and on a regular basis, that can be written off. But if it is part of your home and that is used exclusively and on a regular basis, that can be storage space of business inventory. So know that that room cannot be used for anything else. That room has to be used solely for the business. No, you can't use a home office deduction to create a greater loss. You can only use a home office deduction to reduce net income. The portion related to the home office that can be used to create a loss, or excuse me, other operating costs. So the mortgage interest and the property taxes, you would be able to use against the home because between for the home office because you could use that anyway. But the rent, insurance, repairs, cleaning, utilities, depreciation, None of those could you use to create a loss. You can carry those forward in the future to help offset any future income, but you can't take home office to create a loss. Kiera is a part-time cartographer. She maintains a home office where she coordinates projects and keeps the records. She allocates $12,000 in mortgage interest and taxes to her home office and collects $11,000 in fees. Assuming no other business expenses, what is her current year home office deduction? Will she have a home office carry forward? How would this change if she allocated $2,500 in maintenance and utilities? So, if her income is 11,000 and her home office is just for mortgage interest and property taxes, she would be allowed to take that whole 12,000 in mortgage interest and property taxes. However, if she had maintenance of 2,500, she would not get that in this year because that would create a greater loss for her. She can carry that forward in future years. Okay? Because those additional cost of home office, you have to have at least net income to substantiate those deductions in home office. The calculation of home office expense requires you to allocate the portion that is for the business divided by the total home square footage. So if your office in your home is 100 square feet, your total home is 1,000 square feet, then you're allowed to take 10% of all of your home office expenses or home expenses to allocate towards the home office. This home office expense sheet is Form 8829, expenses for business use of your home. So you'll use that form to determine that portion of home office that will then flow back to the Schedule C. You can do a simplified home office deduction that you take $5 per square foot as a home office deduction. Now, as you can see, that might not be near enough. This example of her taking 12,000 for just mortgage and taxes, you can see that $5 per square foot is not going to amount to much. Hobby losses are not deductible. Hobby income is deductible. That is shown as other income on Schedule 1 of the 1040. You cannot take a hobby loss. Taxpayers can avoid hobby loss rules by using these factors. Is the activity conducted as a business? The time and effort expended? Dependence on the income as the taxpayer's livelihood, whether losses are due to circumstances beyond the taxpayer's control? Attempts to change methods of operation to improve profitability? Previous success of the taxpayer in similar activities in the past? Whether the activity has made a profit in some years, and expectations of a future profit from appreciation of assets used in the activity. So basically, what they're trying to get at here is you may think it is a profit, a business for profit, but the IRS can try to say, no, this is a hobby. I had this situation happen, well, lots of times, but one time in the past 10 years, I had an acrobat pilot who had huge losses, primarily because of the depreciation of his acrobatic airplane. But this guy kept such immaculate records. He showed every air show he was in. He had such meticulous records to even show sponsors to show potential sponsorships, to show that in the future his number of air shows was increasing, that they allowed it to be a business that they saw was for profit because of the way he conducted his business. So, no, when a taxpayer really shows effort to show their purpose is to try to get this business to be for profit, the IRS will allow it, even though it can look kind of like a hobby. But the manner in which that taxpayer keeps the records can say a lot. Tax law provides a rebuttable presumption that if the taxpayer can show a profit from the activity for 3 out of the 5 previous years, 2 of the 7 previous years for activities involving horses, then the activity is engaged in for profit. No, um, yes, but it's not always the case. I mean, there's a lot of big corporations out there that haven't shown a profit in 20 years, and yet they are still a for-profit organization. But yes, this is true. If an activity has shown profit for 3 out of 5 years or with horses, 2 out of 7, then it's going to be treated as a for-profit. Um, Here, this Braden is a self-employed caterer. He drives his personal van when delivering catered meals. You've asked him to provide the amount of business miles, and he says, "Oh, I don't really keep track of my miles. This is what I've um, estimated, or I did 3,000 miles last year." What do you say to him? Well, guys, you're going to tell him he needs to find a way to come up with his miles. He can go back and look at a calendar. He can go and track where he went, but he needs some type of substantiated or contemporaneous records in order to document his miles. Here's a case study of this guy who takes a business trip to Mexico because he renovates boats, and he provides the loans to renovate boats, and he attends this show to stay current on boat valuations. So he goes to the show registration and he has airfare and meals and lodging, and what issues can happen trying to deduct this trip because it's out of the country. And basically, the key here is he needs to show that there was nothing else in the United States that could really satisfy this experience for him. And he needs to keep really clean records to show what he did during the trip down there. So I hope that's been helpful for you. This is chapter 3 of income tax. You guys have a great day.